Hello everyone, I'm Sun Haohao from Group 1. Today, I will briefly analyze the balance sheet trends of Aeon company between 2018 and 2022, focusing on two key issues. First, let's look at the company's cash changes. As you can see from the figure, between 2018 and 2020, the cash balance fluctuated slightly between about 16 million and 17 million. But in 2021, the company's cash suddenly rose sharply to 190 million and further increased to 237 million in 2022. This shows that the company's capital situation has greatly improved in these 2 years, which may be related to its business recovery, improved financing capabilities, or operating efficiency. Next is the borrowing trend. From about 100 million ringgit in 2018, total borrowings soared to 320 million in 2019, the largest increase in 5 years. This shows that the company took a larger financing action in 2019, which may be to expand its business, build new factories, or meet the financial needs of the year. In the following years, borrowing gradually decreased, indicating its debt repayment ability or more efficient use of funds. Overall, Aeon's financial strategy made important adjustments in 2019 and showed a more robust capital structure in the following years. Thank you. That's all for my part.
Now I'm talking about the question 3. Where was the borrowed money spent? In the balance sheet, long-term debt and the short-term borrowings are typically used for the company's capital expenditures, working capital requirements, business expansion, or debt repayment. However, the specific purpose of the borrowing are usually not detailed in the balance sheet, but are provided in the company's cash flow statement or the management's discussion and analysis section. From the balance sheet, we can see short-term borrowings in 2018. They were 480,000 and 100,000 Malaysian ringgit, increasing to 578,500 Malaysian ringgit in 2019, and further rising to 728,500 Malaysian ringgit in 2020. These borrowings may be repaid or converted into other forms of the financing in 2021 and 2022. Long-term debt it was 350,160,000 Malaysian ringgit in 2018, decreased to 205,080,000 Malaysian ringgit in 2019, was now listed in 2020, increased to 327,776,000 Malaysian ringgit in 2021, and dropped significantly to 41,995,000 Malaysian ringgit in 2022. Company have a good credit monitoring system. From the balance sheet, we can observe some indicators that may be related to the credit monitoring system. Accounts receivable, it was 56,246,000 Malaysian ringgit in 2018, decreased to 46,738,000 Malaysian ringgit in 2019, increased to 80,288,000 Malaysian ringgit in 2020, further rose to 93,716,000 Malaysian ringgit in 2021 and dropped it to 80,700 and 2,000 Malaysian ringgit in 2022. The fluctuations in accounts receivable might indicate changes in the company's credit monitoring strategy. Accumulated allowance for the doubtful accounts, it was 7,677,000 Malaysian ringgit in 2018, increased to 9,916,000 Malaysian ringgit in 2019, rose significantly to 25,218,000 Malaysian ringgit in 2020, decreased to 19,937,000 Malaysian ringgit in 2021, and further increased to 21,794,000 Malaysian ringgit in 2022. The increase in the allowance for doubtful accounts may indicate that the company is more concerned about the potential bad debts. Overall, the changes in accounts receivable and bad debt provisions may need to be evaluated in conjunction with the company's credit policy and the market environment to assess the effectiveness of this credit monitoring system. If a company can effectively manage accounts receivable and control bad debts, this may indicate that its credit monitoring is effective. However, specific credit monitoring measures and their effects require a review of the detailed information in company's management discussion and analysis section and the notes.
Now I will talk about whether Aeon made a profit during the year 2018 to 2022. To find that out, I mainly look at the company's retained earnings and total equity. These two indicators can tell us whether the company was keeping profits or losing money. In 2018, Aeon has over 1.2 billion ringgit in retained earnings, which shows that it has built up some profits. But in 2019, the number dropped sharply by over 300 million ringgit. This tells us that Aeon probably had a bad year in 2019. Either they had lost or paid out a big chunk of dividends. In 2020, this retained earnings dropped a little more, but not as much, so that years might have been a break-even point. The good news is that in 2021 and 2022, Aeon's retained earnings went back up, gradually increasing year by year. Also, this company's total equity and book value per share both improved in those 2 years. That means not only was Aeon making money again, but it was also adding value for shareholders. So in conclusion, Aeon likely faced financial pressure in 2019 and 2020, but starting from 2021, the company recovered and returned to profitability. Okay, and then I will talk about how Aeon's assist management impacted its profitability from 2018 to 2022. First of all, let's talk about cash and short-term investments. In 2020, Aeon has about 71 million ringgit in cash, but by 2022, that amount had jumped to over 237 million ringgit. That means this company has better control over its cash flow. Having more cash on hand gives them flexibility to invest, cover expenses, or avoid taking on new debt. Next, their accounts receivable, which is basically money owned by customers, peaked in 2021 but dropped in 2022. That's a good sign. It might mean Aeon tightened their credit policy or improved how quickly they collect payments. Now about the inventory, it stayed highest out of the 5 years. That's something to watch closely. Too much inventory can tie up capital and increase storage costs, but if they manage it well, it also means they can always meet customers' demand. Lastly, Aeon gradually reduced its flagship assets, especially after 2019. Their net PPE went from 5.4 billion ringgit to 4.2 billion ringgit. That may show they were cutting unnecessary costs or shifting to a learning business model. So overall, it's improved asset management, especially in cash, receivable, and capital efficiency, helped them rebuild profitability after 2020. That's all.
Afternoon, Dr. I'm Meiji. I'm going to present about question 7, which to what extent the trends in the working capital affect the cash flow. You can see that actually between the 2018 and 2022, the company cash is reflected to increase significantly by the 155,319K, which the 189% and reflects the stronger liquidity due to the better cash management or reduce the capital effectiveness. Actually, the account receivable also rose by the 24,456K, which the 43.5%. We could induce the higher credit sales of the slower collect period. Actually, the potential also try out the cash and negatively affect the cash flow. However, the inventory level decreased by the 274,661K, which the 11% is suggesting to improve the inventory management. Actually, it's reduced in the inventory. Actually, it's a positive sign. That means it will help to free up the cash will otherwise will be tied up in the stock. And furthermore, we will increase the company overall cash flow also for the financial position. And we continue. Actually, between the 2018 also for the 2022, the account payable decreased by the 171,026K, which the 19.7%. Actually, is also show the faster payment to supplier with stronger the relationship, but also reduce the available cash. And others current liability also increased slightly by the 12643K, which 2.8%. The negative net also for the working capital also improved from the negative 1427667K in 2018 to the negative 966363K in the 2022. That means it shows as the better working capital management. So while the current liabilities still also more than the current assets, we can see on the data that I showed in the slide there. The improvement also will suggest the reduction in the cash flow. Also, it will important for reduce business with higher payable also for short-term borrowing. And also, I want to present about the impact on the cash flow. Actually, the increase in the cash reserves actually which the 155,319K and reduction in the inventory 74,661K, that means it's positive impact the cash flow. However, the rest of the account receivable which 24456K, that means is the decrease in the account payable which the 171,026K. That means it tie up the funds. That means it's a negatively affect the cash flow. Actually face these the challenges, the reduced negative network capital also show that the Aeon has increased and also improved the management of these short-term assets also for liability, and also is resulting in a more healthy cash flow position overall. And also for questions 8, the questions which how to change in this liability also affect the company financial position also for reporting the practice. Actually, we can see that from the 2018 to the 2022, the current positions like the reporter of the list rose by the 282,618K, which 171%. Also, we will show that is the higher short-term list obligations which could affect the equity ratios. Actually, the long-term list also decreased by the 533,4 0.58k, which is 24.9%, slightly due to the renegotiations of the assets purchase. If we reduce the long-term liability but possibly to increase the depreciations, overall the total lease liability decreased by the 230,757k, which the 10%, also show that is the reduction in the risk commitment to improve the financial flexibility or manage the risk related the obligations more effective. And also for the next one, we want to talk about the financial position impacts. Actually, the overall the inclusions of the lease liability in the balance sheet also increase the total liability to making the company appear more leveraged. For example, in 2019, the total liability rose to 4842104k is partly due to the 2146,022k in the long-term lease. That means the higher current lease obligations such as the 447,781k in the 2022, we will reduce the liquidity ratio. That means it will show the more higher liquidity. Additionally, the lease liability also are the part of the total debt. Actually, with the 2277187 in the total debt in the 2022, that means will be the impacting leverage ratio, also potentially will affect the company borrowing capacity. And the last one, I also want to present about the reporting practice. Actually, the new risk standard also want to enhance the transparency through the detailed disclosures, but also increase the reporting, the complexity, as also the operation list also now in the result in the decrease of the interest expenses. Actually, that means we will altering the expenses profile. Actually, the fluctuations in the lease liability like the 34.9% drop in the long-term lease from the 2019 to the 2022. Actually, we also created the volatility, also required the adjustment in the financial analysis. So that's all for our presentation. We are from Group 1, so have a nice day. Thank you for watching our video.